Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go over Twitter, go over some information that I've been following on Twitter, share it with everybody, give my financial opinion. So let's dive in, let's take a look at what's going on. One of the things here is if you want to follow me, it's at finding_finance. And we've got Grady up here. Last time this ratio chart had this kind of very large red positive divergence, the massive bull in mining started. It now has that look again. And what this chart is the platinum to palladium ratio. We've talked a lot about platinum and how I'm very bullish on platinum. And a couple of things I want to obviously point out here is, we've got the relative strength indicator. It is going up. I don't really use that too much in my analysis. But what I do want to cover is an expensive ratio back in the 80s and 90s, and also in the mid 2000s. This ratio worked its way higher, where platinum could buy 4 to 5 ounces of palladium. So the ratio right now, it is 0.44. It is very cheap for platinum. And with a ratio like that, you can dramatically leverage your wealth against other metals when the ratio goes to a very low level. So platinum is not only incredibly cheap, I think that we're coming into an area where we're going to see a positive move in platinum given the market conditions. So everything looks good for platinum. Scrolling down, I thought this was kind of funny. It says she's an 8, but she is your new mortgage rate. We've got graphite stocks commencing their rally. I think I'm seeing a lot of positive movement in graphite. We do have supply-demand imbalances out in the future, deficits for graphite, and they're starting to move. So that is one thing that you may want to look at. This one is goth silver, and what this is the inverted Exter's pyramid. So we've got derivatives at the top, which is basically the highest risk going to the least risk. Derivatives, private business and real estate, securitized debt and listed stocks, government bonds, bank money, base money, and then gold. And what we're seeing is some problems in government bonds around the world with the increasing interest rates. Things are starting to potentially break, but I think they'll transfer that pressure down here, base money or bank money. So that's where I think the risk, if you were to look at it, the risk declining goes down, and gold, silver, other precious metals are at the tip. So I think this is obviously the least risk area, and when things become risky in the environment or market conditions, money will flow down this pyramid to the tip. I just wanted to retweet this. Someone posted this not too long ago. It's crypto's in a bubble, tech's in a bubble, VCs is in a bubble, biotech's in a bubble, passive investing's a bubble, Web 3.0, green energy's a bubble. The metaverse is insanity. Can't they see they are all wrong? October 30th, 2021, basically at the top of that bubble from Raoul Pal. Everyone can get sucked into this, guys. They can. There's zero context to this graphic, but a comparison that is overly simplistic. Markets are very complex, and this doesn't consider taxes haven't risen, nor the absolute lack of refining capacity we have this year. As an analyst, this graphic is absolutely horrendous. And someone posted this, and I do think that it's very, misleading. But gas prices are $1 a gallon higher than they should be because of big oil's greed, and I disagree with that. What we have is refining tightness. That's what this crack spread is. So even though the price of oil is the same, the gasoline prices are different by $1. And that's that crack spread. And if you don't invest in refining capacity, your crack spreads can go quite significant to the upside. And that's exactly what we're experiencing. It's not big oil's greed. It's the crack spread and the refining tightness. Panic selling. So the Hong Kong market is seeing a panic selling moment. It is obviously rolling lower here in Hong Kong. So a lot of panic going on over there. Things are selling off. We've got lies, and statistics. I have updated this opinion chart with fresh data. China imported a record of 1 million barrels per day of Malaysian crude in September. That's nearly double the real output of Malaysia. The reality, rebranding of Russian, Iranian, and Venezuelan oil. They're smuggling oil. Chinese imports of Malaysian crude oil have surged above what the country actually produces. The reason? Probably rebranded oil from somewhere else. Just an FYI. Here's an interesting take. It says this week gold broke out against treasury bonds, another ratio. TLT for the first time. As we head into a recessionary territory, it is very important to reallocate your portfolio around the right safe haven asset classes. They have silver there, but gold breaking out against this, against TLT. Now, what we want to see is this needs to stick up here. So we need to stick, we need to close, and then work our way on higher. But that is a new development there. We've got Deep Yellow released some positive uranium results from its two-stage 10,000-meter follow-up RC drilling program at Omahola, which is progressing as planned. Phase 2 of the program is underway with 43 holes for 2,950 meters completed. 30 holes remain to be drilled. So that's Deep Yellow. Whoops, next hour, natural gas price turns negative. This is over at TTF Dutch Spot. So what is happening over there is they're filling up their inventories, and now they have nowhere else to put it. And it's happening again, just like oil prices did at the bottom of the oil market. The volatility in TTF is insane. We went from 300 down to, which could be 0 or negative. So the inventories are basically the size of those inventories, and how full they are, is determining the natural gas and or oil price. But what we're looking at now is flow rates. So this could go up just as fast. So the opportunities here, I think, are quite ridiculous because your downside risk is now, I would say, quite low when this bottoms out and turns around. And the upside potential is quite great depending on what the weather is. And the weather over there is also quite warm right now. So yeah, that's what we've got there. We have 2022 year to date. Berkshire Hathaway down 5%. A whole bunch are down. 5% minus 15 for the Dow Jones, minus 21, minus 30 for the NASDAQ. Bitcoin's down 60%. ARK is down 62. And then we've got oil and gas stocks up 47%. I love it. I love it. So that's the outperformance of energy. That's where the majority of my holdings are at, is in energy. It says big China crude demand data print. It says latest Chinese data shows refinery runs hit their highest level in September, about 14 million barrels per day since February, before the ramp up of China's COVID-0 lockdowns. That's up 1.2 million barrels per day, month over month. So big increase in demand. And we also had other information that was conflicting to this. So we've got a bunch of conflicting data, and it's getting a little bit weird on how this data is rolling out on a lot of these areas. I know oil's down today, but demand is up. And I think there was some data that was released that it's basically going against this data here. That's why I'm sharing it. It says European energy crisis on hold due to unseasonably warm weather, diverting LNG cargoes in nearly full storage. It says European natural gas prices fall below the $100 per megawatt hour for the first time since June. The risk of winter shortage are receding amid outlook for warm fall weather, ample stockpiles and strong LNG deliveries, demand destruction across industries. A permanent structural change in leisure demand because of the flexibility that hybrid work allows. It looks like hybrid work is allowing people to travel more. It says there's been a permanent structural change in leisure demand because of the flexibility that hybrid work allows. With hybrid work, every weekend could be a holiday weekend. That's why September, a normally off-peak month, was the third strongest month in our history. That's pretty bullish for jet fuel demand. It says United States wage increase approaching 1970s type of acceleration. I think this is kind of interesting. This is from Patrick Karam. The wages since 1964. So this is kind of the 7-year rate of change with 7-year moving average, and it's been moving higher here, approaching the 1970s type wage increase momentum. Very interesting there. And maybe wages will catch up and start moving on higher. Here's Uselink. This is Casper. It says uranium is the investment of this decade, in my humble opinion. Please link or like and retweet so that we can get as many people into this great investment opportunity. I agree. I think uranium is a really good investment. Here's JC. It says last time net long positions in gold were at such depressed levels, prices surged $700 in short order. Conditions are much more favorable today. Larger deficits, war, rampant inflation, de-dollarization, cratering inventory. We may be on the cusp of an epic rally for gold. Here's the COMEX gold, the gold net spec position, gold price. So we can see that this is coming on down for net contracts with it. In COMEX long gold is very low and short gold is very high. And we could see that reverse quite dramatically with price. So that's what it's looking like for gold. And that's what I've got there. We'll end it there. That's all the information. But lots of volatility here, guys. Expect volatility. Expect large increasing swings based off weather, based off the natural gas price and TTF. And we're going to see a lot of volatility. So get ready. Strap in. If you guys like the content, subscribe to the channel. Give me a thumbs up. And don't forget to subscribe to the website, Platinum membership. If you guys are interested and need help playing this bull market, I'm seeing a lot of information out there that's positive. Looks like a lot of the charts are turning, trying to put in bottoms. I am seeing a little bit of selling pressure pre-market, but yeah, we'll be all right. We'll catch you next time. This is Finding Value.